Good afternoon, Montrose. How you doing? How's the food? All right. Thank you for coming. We're going to get started because we just have a lot of information as you gather, and so we're going to try to squeeze it in. We're going to speed talk, so hopefully you won't fall asleep and your head won't fall into the lasagna. And so we'll just get going on a lot of things. So let's see here. Oops, wrong one. Okay, disclosures. Whatever we say, do here today, you can't sue us. Please don't sue us. You have to go see an attorney, see your accountant before you do anything that we recommend. So, today I'm going to start off. They're shoving me at the beginning. I'm going to talk about some good information. Daniel's going to talk about the global economy, and Jamie's going to talk about what are we actually doing in your portfolios. Okay? The big question is, I'm not retiring yet, okay? I just turned 63 last week, so I'll still keep working. I tell people I'm cutting back to half days, 12 hours. So I've been known to leave the office a little earlier when I get tired and need to go take a nap, but otherwise I'm still working, so don't worry about that. I'm not abandoning the office or anything like that. So, but you know that eventually I'm catching up to your age and I'll be joining the ranks of retirement someday, but not right now, okay? All right, at each of your places is a survey. Please do us a favor and fill out the survey, write questions down, and there's notes for you to take home. So write down if you have questions, if you want to talk specifically about something, then write it down, say, I want to have you talk to me about this or that. So please keep the survey and those 2 pages there readily available. You all have fancy Eldorado pens, so please use them. Okay. Just a couple fun things before we get into the doom and gloom of this wonderful world we have. Upcoming and on October 8th at our farm, we have the Fall Harvest Festival. That's where you can come and pick pumpkins, all the pumpkins you want. We have chilies, so you can, it's a you pick. We roast, Daniel's roasts the chilies for us. We make apple cider, we'll have popcorn from our farm, just kind of a few fun and games. So bring your family, bring friends, just come out there, no charge. Just come and take all the pumpkins, because the pumpkins you don't take, our chickens get to eat all winter long. So take all of them. We have all kinds of designer pumpkins, warty ones, and little Jack-be-littles, and big jack-o'-lanterns. And then December 8th, the next 8th, or the 2 months from that, will be our open house at our office. As you know, with COVID, we used to have it 4 to 7, and it was so packed you never could move around. But because of COVID, we changed that, and we like it now because you all can just come in trickles all through the day. So between 1 and 6, you're welcome to stop by, have some cookies, some food. We have it catered. You can chat with us, and it's just a lot more relaxing environment. So don't forget about the open house. You'll be getting that in the mail soon. You should have that, right? Yeah. Okay. The office doesn't tell me everything. What's going on? Okay. So first piece of business. Schwab and Ameritrade. You know that Schwab purchased Ameritrade 2 years ago. They're slowly going through this transition of merging the 2 companies together. Many of you have already received information about is your data correct? What they're doing is cleaning up data from clients that have been with them for a long time. When Janet and I first started the business, the company was Jack White, and we actually knew Jack White in San Diego, and Jack White and Charles Schwab started the discount brokerage business. So they were the founders of that whole industry, and we got to know him and work with him. Then Jack White sold to Waterhouse, and then Waterhouse sold to Ameritrade, and Ameritrade then with Toronto Dominion Bank. So now Schwab couldn't beat their competition. They never could beat Ameritrade, so they said, let's just merge. And so what they're doing is taking the good parts of Ameritrade, merging them with the good parts of Schwab, taking all the bad parts of those two companies, getting rid of that, and hopefully we'll have a really good, solid company. So expect in April, roughly, is when you'll actually see changes. Right now, behind the scenes, it is Schwab. And I'll show you what's going on with another investment that you'll find out here. And so behind the scenes, it's mostly Schwab. When we're buying and selling and using their platform, it's on the Schwab platform. But you don't really see it because your statements still say Ameritrade. But you're going to get a new account number eventually, which will be a pain. When you need those changed, then we'll probably have meetings where we'll sit down and show you how to read the statements, how to hook up if you're using Quicken or anything else, TurboTax, how you can work with the new arrangement with Schwab. So don't freak out over it. If you have questions, call us. They're amazing. Jamie is working with them. She's on the team that they ask her questions. What do you think about this? And what do you think about that? And she's on the keyboard pounding out answers and saying, you're doing this wrong, but you're doing right. So we're very involved in this. So don't panic. Hopefully it will go smooth. But when Janet and I went through 4 of those changes, a couple of them were disasters, and I don't have time to talk about one, which was very hilarious. But anyway, so next one here is, and we have Jessica. She's been with us since March. So officially, because she came in right after our seminar, and so you all may not have met her, but when you call, she answers the phone along with Charity. So we really needed help with the merger and the growth of our company, and we just needed another person and to help out Janet with her trading and Daniel with all the trading going on and other situations. So welcome her. Be nice to her. Don't scream at her. She is not oh yeah, by the way, so my daughter is Jamie, but I have a daughter named Jessica, but she's in New Mexico now. Used to be in Bismarck, but she's in New Mexico. So that is not my daughter, okay? And she will really let you know she's not my daughter. Okay, let's see here. Okay, this is a side note here real quick. So you've heard about the IRS hiring 87,000 new agents coming up for audits. So the thing is, you have to understand a couple things. First of all, they're going to have to train 87,000 people to understand the 100,000 pages of tax code. It's going to take years and years for people to even understand what's going on and how to understand the tax code. So don't worry, there's training. There's like 8 million unprocessed returns from 2 years ago. So they haven't even gotten to those. So don't worry about them chasing you down today. There's only 11% of all the telephone calls are ever answered when you call the IRS. So there's going to be many more people just there to answer calls so you can answer questions too. And then also the workforce is aging because they're all aging, and so a lot of these people will just be replacing other workers. I have a friend in Denver, he was an IRS auditor for years, and he just retired, and they had to just replace him. Okay, so don't worry about that. Oh, okay. Recession. Are we in a recession? Hands, who thinks we're in a recession? Who does not think we're in a recession? Okay, so what's the definition of a recession? First of all, I'm calling this a manufactured recession. And the reason why I say that is it was created by Washington, D.C. When you spend so much money, I'm not getting political, left, right, Republican, Democrat, doesn't matter. All of them spend too much money. And when you spend too much money, they're printing out money, people have too much, they're spending, right? After COVID, we had crazy lines at the airports to all the other places and spending money. You can't even buy cars. And so it caused so much demand. And so when you have too much demand and not enough supply, it causes inflation. They're also, when they cut back on the oil and energy, that affects all kinds of areas. So, definition of a recession is zero or negative growth for at least 2 successive quarters. Well, the first quarter of this year, we had a negative GDP, and then the second quarter, we had a negative GDP. Guess what? We're in a recession. Now, a lot of people say when we get to a recession, because it may not feel like a recession. All us, the retired folks here, it probably doesn't feel like one, but we are in one. And now with raising the interest rates, it's going to push us further down because it's going to slow the housing and so on and so on. So we are in one. It's just going to get worse. Okay, inflation this year is 8.3%. Okay, does that seem very bad? Do you think it was as bad as it was in 1980? It wasn't, okay. Why? Because inflation in 1980 was 15%. But let me tell you something. When this happened, they have the cost of living and Social Security, and everybody's benefits were rising at 15%. And our government realized we can't have inflation that high. So therefore, then they created core inflation. And I'm not going to get into it, but they created core inflation. Then they created chained inflation. And then they also then invented deflator numbers. What the heck is a deflator number anyway? I don't know. So by changing that all around, our inflation really now is about 15%, okay? It really is. If you look at real inflation, they're telling you it's 8.3, but when they play with the numbers and they change all these things using core inflation numbers and all these other things, that pushes the inflation number down, and it seems like we don't have inflation. But we still have the same real inflation. If you go to the grocery store, you're seeing Cheerios up 15% and all the other costs. Daniel might have a slide he did last time. And then what's going on is and what's happening is the Federal Reserve is trying to control inflation, so they're raising the interest rates. And that will slow down the building, slow down the manufacturing, slow down the economy a little bit. So there's less demand. They're working on the demand side, and the supply side then hopefully will catch up. Okay, so this is just a cool graph to show you about how inflation has changed. So what's happening here is, up in here is in COVID. And so the COVID, they lowered the interest rates way down low to almost zero. And now you're starting to see, coming up, the interest rates starting to increase. And see how fast they've grown, really fast. So what this is showing is the cliff. We had interest rates, and then COVID happened, and remember they just dropped interest rates very fast because COVID came very quickly. And then we had basically 0% interest rates until October, and then they've been increasing them drastically, and it's still going up. They still have several more increases. So this is just showing you a visual of what's going on. So we've had very low interest rates. So what's happening then with this? Is this good or bad? The answer is it depends. Okay? What side of the interest rate are you on? Are you a borrower or are you a lender? Are you an investor? Most of you are investors. So good news is that now we have 9-month CDs available at 4%. We haven't had that in 25 years. I mean, for years and years, people say, I want to put it in a CD. I want to put it in a CD. I want safe, secure stuff. Yeah, but you're getting like 0.0% on a CD. Finally, they're moving up, and so we're able to purchase this, and this is because of Schwab. Ameritrade did not have access. Schwab has trillions and trillions of dollars, so they're able to go out and buy a $100 million CD and give you a 4% for only 9 months. Now, this is only really temporary. You don't want to be putting your retirement money in a 4% CD. Because the markets are down 23%, and Jamie will go through that, you need to take advantage and be ready to be in the market or buy into the market, because you can get easily a 23% increase plus some additional increases on top of that. So I just wanted to share that with you. Also, for everybody, we had short-term bonds, the Schwab short-term bond, and it was struggling because the bonds struggle, and Jamie will explain this. But now we've switched over to the Schwab has a money market paying 2.5%. Money markets are very liquid. You can get in, get out. So the 2.5% we have is far better than any bank that you have here in town that you can get. So just letting you know, if you have money on the side at a bank and a thrift savings account, you know, annuities and so on, getting short-term CDs, and these will fluctuate, you know, and as the Federal Reserve keeps raising rates, that will go up to 4.5% and 5%, and it will creep up. So it's just another tool, but I'm not saying this is the answer, but a lot of you have cash at a bank getting 0%. So if you're interested, put that on the survey and let us know, and we can help you get into that, okay? Next is Daniel. I didn't do that. Yay! I'm sorry. Really hot. Of course, I'm the problem child.
Check, check, 1, 2, 3. Can you hear me okay? All right, well, enough with the technical difficulties. Sorry about that. Let me move that over here so I don't spill it on the computer. All right, so I have the pleasure of talking about what is happening in the global economy. What we're going to go over today is just all the crazy change that's been happening as that relates to our US dollars. Everybody's talking about Russia, everyone's talking about Ukraine, everyone's talking about energy crisis in Western Europe. There's an underlining issue that I don't think gets enough press that kind of leads into my third part, which is just basically the future. What does money look like? What does finance look like? What does geopolitical relationships look like? So I don't get paid nearly enough to predict the future, but hopefully we can use enough wisdom from the past to at least get a general idea of where we're heading. So, needless to say, our world is changing. It is changing fast. So fast that sometimes it's hard for me to keep up with sometimes. With that change, we cannot fail to innovate. We cannot fail to be forward-thinking. Blockbuster and Eastman Kodak learned that lesson the hard way. Blockbuster had the opportunity to start streaming movies and TV shows over the internet, kind of like what Netflix and Disney Plus and all those guys are doing now. And so they failed to innovate. And so that's kind of, you know, when was the last time a Blockbuster was in Montrose? I heard there was one here. So Eastman Kodak's a funny story. Back in the early 90s to mid-90s, they were experimenting with this idea to allow people to upload their pictures to this thing called the internet. And what they didn't realize was that they were basically the forefathers of what we now call Instagram. This social media platform sold to Facebook in 2012 for $1 billion. And if you ask me, that was really cheap. New York Times back in 1985 put out an article saying that the personal computer has absolutely no application in the average American home. So there's a lot of change happening. And the backdrop of what I'm going to be talking about is as we make changes to portfolios, kind of like what Jim mentioned with the short-term bonds. Okay? As our world is changing, we're staying on top of the change, and then we will make adjustments accordingly. So, with all that being said, what's happening in the economy? I want to start with our US dollar. The dollar index is up 19% year to date. It's at its highest level in over 20 years. Now, the dollar index takes your dollars and it basically compares its relative strength to the euro, the yen, the pound sterling. God rest Her Majesty's soul. I couldn't find any pound sterlings with King Charles's face on them. Canadian dollars, this is the Swiss franc and the Swedish krona. So it takes that basket of currencies and compares it to the US dollar, and then you can get an idea of what the dollar strength is relative to this basket of currencies. Now, The dollar index is not to be confused with what your dollars are doing compared to goods and services. So compared to other currencies, the dollar is really strong. Arnold Schwarzenegger, I'm here, you know. Your US dollars, because of inflation, compared to electricity and gas and food, isn't doing too hot. And Jamie's going to talk a little bit more about that here in a little bit. Come on. So just don't get confused that your dollars compared to goods and services as measured by the consumer price index is not the same as the dollar index. So I just want to make sure we were on the same page on that. So here we are. We got our strong US dollar. It's going up in strength. Now, what happens from a global macro perspective, when the dollar is really strong, that means that it's a lot harder for foreign countries and even foreign corporations to get access to dollars. It's more expensive for them to get dollars in their hands or in their accounts. So that means, in essence, there's less liquidity and cash flow in the global economy. Now, why would, like, Japan, for example, need US dollars? So, for example, you know, Japan, let's say they have to go to Australia and they need to buy copper from Australia. Well, the Australians don't want to use you know, Japanese yen. The Japanese don't want to use Australian dollars, so they agree to use US dollars. Long story short, a lot of our international trade between countries, about 60% uses US dollars, and the big reason why is because we won World War II. We told them to peg their money against our money, you know, America. So there's less liquidity and cash flow in our global economy. Now, if Japan, or whatever foreign corporation you might think of, needs to get access to dollars so they can go out and trade, that means that Japan has to basically create more yen into existence, go to the World Bank, exchange or sell their yen for US dollars, and so that way they can continue to trade internationally. Now, if I'm Japan and I'm sitting, you know, with however many billions or trillions of US dollars in my bank account, earning nothing, do I just want to let it sit there and rot with all this global inflation that we've been seeing? Probably not. What's the one place that I can definitely use US dollars and get it invested to at least have some kind of return? Right here in the United States. A lot of these foreign entities are then incentivized to buy US assets. The 10-year Treasury is paying 3.8%. The German 10-year Bund is paying a little bit more than half of that. And then the Japanese 10-year is not even paying 0.25%. So if you had to choose which one you're going to buy, I mean, it's pretty self-explanatory. Bloomberg put out an article saying that for the first time in 3 years, foreign investors are piling into US real estate. From China, from India, from Canada, everywhere else. And so they have all these dollars and they're just piling into US real estate. If I remember correctly, the 44% of those international entities buying US real estate, 44% of those deals are 100% cash offers. They're not financing it. So part of the reason why I think our real estate market it's dipped down a little bit, it's cooled off a little bit. We're already seeing that cooling, but part of the reason why we haven't seen like a full-on crash with like the 7.5% 30-year fixed interest rates, I think is just with the foreign demand that's coming outside our country. This information's a little bit stale going back to 2018, but it still proves my point. There's an Australian economist that I like to follow, and he admitted that 1/3 of his portfolio is in US stocks. And if you compare, so back in 2018, our stock market was valued at 30 trillion. Here's China, here's Japan, here's Hong Kong, Canada, Saudi Arabia, everyone else in between. So this is our stock market compared to everybody else. And so I went on the World Bank Group's website and I actually looked at the current numbers. As of March 31st of this year, our stock market had a total capitalization of about $38 trillion. Give or take, but with everything going on now, it's kind of dropped a little bit. I wouldn't be surprised. So there you have it. So you have dollar goes up in strength. You have less liquidity and cash flow in the global economy. Countries have to sell more and more of their own currency to get dollars. They're then incentivized to buy US assets, which then pushes the dollar up even more, which then there's less liquidity, and then it's just this ugly little cycle that happens, okay? Now this is where we get in the meat and potatoes of the whole story. What do you think happens when countries continually print more and more of their currency, all while finding it harder and harder and harder to service their sovereign debt? To answer that question, we are going to go to Sri Lanka. If it would play.
Sri Lanka's Prime Minister says his country is now bankrupt and that there's no immediate end to the current economic crisis. Sri Lankans are facing hardships on many fronts. Petrol supplies have dried up because foreign currency reserves to pay for fuel imports have run out. Prices have soared, with food inflation now running at about 57% annually. More than 2/3 of Sri Lankan households say they're eating less as a result. Schools and offices are currently closed to keep people off the streets. People are angry and frustrated, and they're blaming politicians for the crisis, especially President Gotabaya Rajapaksa and his family, which dominate politics.
So the US dollar increasing in strength is not the whole story. Sri Lanka, if you dial it down to that one country, for the last couple years, they implemented some economic policy that really hurt their agricultural-based economy. They're not as developed as we are here in the States. So, but it still nonetheless kind of supports the idea that the dollar increasing in strength just makes it a lot harder for these emerging market countries to stay solvent. Now, one of the things that we're kind of looking at and trying to look out for is the possibility of a global credit crisis, okay? Now, back in 2020, when interest rates were, dead low, nothing, none of the bonds were paying anything, a lot of investment firms were telling us, oh yeah, you should buy emerging market bonds because they're basically the same return as emerging market stocks, but with half the risk. And I'm kind of sitting there and I'm just shaking my head like, I don't think so. So we purposely, in all of your guys' portfolios, stayed out as much as we can out of emerging market assets. And if you want to notice too, if you go back to kind of how the US assets increase with all that demand from foreign countries, if you look at your portfolio, you'll notice that a lot of the stock exposure, so your equity exposure, is domestically here in the United States. We give you a healthy amount of international stocks for diversification, but for the most part, a lot of our exposure to stocks are going to be here in the United States. And that's, again, partly because we knew the dollar was just going to keep screaming up in strength. So in portfolios, we've kept international exposure to a minimum. We've also stayed out of emerging markets. Now, global inflation. Venezuela is sitting at about 103%. Turkey is about 80%. There's a gentleman I actually met not too long ago. He and his wife went to Turkey, I want to say, earlier this year, give or take. And even with all the crazy inflation going on over there, they were kind of genuinely surprised on how incredibly cheap it was for their trip to go over there. And I said, well, yeah, your dollars are like so much more valuable. And so with avoiding emerging market assets, knowing that we have a lot of international inflation, the UK, I think that Citigroup expected that UK, with everything going on with Russia and Ukraine, is going to have about 18% by the end of the year. So with all this global inflation, one of the things that we started doing several months ago was we started incorporating international inflation bonds. Last year, I talked about how we started incorporating Treasury inflation protected securities. Those are special Treasury bonds that are paying you interest based on inflation. And so those are paying pretty decently right now. And so what we've done for the international exposure for the bond section of your portfolio is start putting in these international inflation bonds. And it's just the game that we have to play right now, trying to get as much income that we can from this so that way we can use that cash to buy the stock now that the market's at a discount, okay? Buy low, sell high. Okay, so you have an idea what's happening. You have an idea what's going on with the dollar. You have an idea of just kind of what we're expecting to see. I want to shift gears for a second. I want to talk about some poker. One of the dumbest things I can do playing poker is show my hand. If you and I are playing, we're playing a game, we're playing cards, you know, you're trying to implement a strategy and you're making moves to win the game based on how I'm playing the game and strategizing and what moves I make. And so in economics, we call it game theory. So when you show your cards, you lose all leverage that you have, right? You kind of compromise your ability to win the game. This is kind of where we get a little bit of history. On August 6, 1945, we dropped the atom bomb on Hiroshima, Japan. We ended the war. We stopped the bloodshed. Everyone started waving the white flag. Now, the question that I always try to ask is, what are the unintended consequences? How many of you guys got your little voting ballot or little booklet for voting in the mail recently? As I am looking through these laws and these propositions and the things that the state of Colorado wants to change, I'm always in the back of my mind trying to ask, well, what was the unintended consequence? I mean, so I kind of get where these guys are coming from and why they're wanting to do this, but what are the unintended consequences? So going back to when we ended World War II with the Hiroshima bomb, okay, yeah, we ended the war, great, but what was the unintended consequence? In other words, did Russia just sit there, twiddle their thumbs, and hope to God we didn't use the same technology on them? No. They developed their own nuclear arsenal. They used mutually assured destruction as the insurance policy. And now you just sparked, unintentionally, a Cold War era that would last for decades. So now you're probably wondering at this point, okay, so why are we talking about the Cold War? Why are we talking about poker? Why are we talking about all this stuff? Raise your hand if you think that history has a funny way of repeating itself. You might not be able to predict exactly what's going to happen, but there are some common themes that we can draw wisdom from. When Russia invaded Ukraine, the United States and all the NATO allies, through the book of economic sanctions, or the nuclear launch code, so to speak, of economic sanctions against Russia, we watched in real time the Russian ruble tank in value. The Russian stock market had been closed for months. Russian assets were being seized all over the world. McDonald's gets about 10% of its global revenue from Russia and Ukraine. British Petroleum, Shell, losing tens of billions of dollars. Starbucks, Coca-Cola, Mercedes-Benz, Rolex, all this chaos was from an economics perspective was happening, not to mention supply chains and all that stuff. And so, what is the unintended consequence? I understand why we did it, but what was the unintended consequence? Russia and China are working on a currency that's going to rival the dollar that's, from what I understand, is primarily backed by commodities. And so we're seeing those, basically those checker pieces put into play. Now, oil, when it's traded internationally, typically it's denominated in dollars. Everyone uses dollars to trade oil with each other. The Bank of India, or India in general, I should say, struck a deal with Russia, and they're basically getting oil from Russia, and they're not using US dollars anymore. And it's not only the bigger developed nations that are putting into question relying on US dollars, but it's also, it's also smaller nations like Nigeria. They're not using dollars anymore. They're trying to get more people to invest in their cattle farms. So what can we draw from this? What do we think the future looks like? So on one extreme, one thing that I think we're going to start seeing within maybe the next 10, 15, 20 years, mind you, I'm not making a prediction. Trust me, I don't get paid enough to do it. So one thing that we'll start to see is more and more nations will come out with what's called a central bank digital currency. I don't have enough time to explain exactly what that is. Basically, think of it as a digital dollar. So instead of paper money, instead of using this, it's all this. So more and more countries like China and Russia are going to have digital currencies where they have an ironclad control over it, which makes sense. It's kind of part of their repertoire. Now, on the other extreme, we have these guys. Earlier this year, 44 central bankers representing 44 different nations, Mongolia, Sudan, Paraguay, Jordan, Egypt, Ghana, Uganda, Haiti, Costa Rica, the Dominican Republic, and those are just the ones I can name off the top of my head. All these guys went down to El Salvador earlier this year. By a show of hands, how many of you guys went to my Bitcoin seminar in May? Yes. 44 central bankers from 44 different nations went down to El Salvador to learn about how Bitcoin worked. El Salvador has officially been on the Bitcoin standard for 1 full year. Now, in my opinion, it's too early to say, okay, is it a good idea, is it a bad idea? In my presentation, if you want me to send it to you, I can send you a link. It's on our Facebook. It should be on our YouTube channel as well. But I talk about all the crazy things that Bitcoin, or what kind of crazy impact our world is having just with Bitcoin and all the crazy cool stuff that it's doing. There was a story recently I heard about a gentleman in El Salvador. He would have to get on a bus, ride an hour outside of town, wait an hour in line at the utility office, pay his electric bill, and then ride an hour back to his house. So it took him 3 hours to pay his electricity bill. With Bitcoin, he does it in like 15 seconds. So in the future, we're going to see more and more central bank digital currencies, especially with regimes like China and Russia. I also think that we're also going to see more and more countries jump on the Bitcoin standard. We're already seeing legislation in Paraguay. We're seeing legislation, or not Paraguay, in Paraguay, Panama, Argentina, and I think even Rio de Janeiro in Brazil is already thinking about jumping on this stuff. But I want to ask a simple question, and this is kind of making this thing full circle. Do you think these guys understand what happens when the dollar increases in strength? Do you think they understand what's going on in Sri Lanka? Do you think these guys have an incentive to wean themselves off of the dollar? Oh, and by the way, in case some of you are thinking, well, Daniel, Bitcoin is not money. This is a white paper from the Federal Reserve of Cleveland, basically stating that the Lightning Network, technical jargon, don't worry about it, is basically what's turning Bitcoin into money. If you want to copy and read for yourself, I got some right here. So where does that leave us? Where do we go? What do we do? I mean, your guess is as good as mine. I mean, it can really go either way. If I had to make a bet, I think the United States, and I would even throw Western Europe for that matter, would probably try to find some way to operate between two extremes. So on one end, the United States Federal Reserve is already working and researching into a kind of a digital dollar program. But at the same time, given all the trade, supply chain issues and the trade wars and the sanctions and stuff like that, I honestly think that at some point the United States is going to have to play ball with these smaller nations in Bitcoin, considering the fact that a lot of these guys are rich, absolutely rich in natural resources. And in case you don't believe me, just watch.
A bipartisan pair of senators floating an idea that could make paying with cryptocurrency much more of an everyday thing. Ylan Moya joins us with the latest on that. Good morning.
Well, good morning, Andrew. That bill is being introduced today, and it would allow consumers to buy things with Bitcoin without having to worry about paying a capital gains tax. Now, this proposal comes from Republican Senator Pat Toomey and Democrat Kyrsten Sinema. The goal is to encourage public adoption of cryptocurrency by making it easier to conduct everyday purchases. Right now, if you buy something with Bitcoin, even just a cup of coffee, you could technically owe the IRS capital gains tax on the crypto that you used. The Virtual Currency Tax Fairness Act would exempt transactions of less than $50 from that requirement.
This picture right here, Bitcoin accepted here was, this was taken earlier this summer at the farmers market here in Montrose. Colorado, I announced last year, was going to be the first state to start taking in like Bitcoin and other cryptocurrencies as an official form of paying your taxes. They said it would be done by this summer. It actually just happened this month. Now, I want to end with this, and I'm gonna make it pretty simple for you guys. I understand. I get it. It's confusing. It's a lot. It's scary. There's so much going on, so much change happening. I get it, all right? But the important thing that I want you guys to take away from this is that someone's cell phone's going off. There we go. All right. I might start charging for a dance now. No. You're good. You're good. No, you're good. I was having fun with that. I don't know, why'd you stop? No. So I get it. There's a lot of change. It's scary. It's confusing. It's a lot. It's probably more than what you signed up for. But if there's one thing I want you to take away from this, is that it's not just you guys. It's Jim. It's me. It's Jamie. It's all of us in this room. We're having to navigate this change together. And if you ask me, I think the stakes are way too high to be afraid of change. As we make changes to the portfolio, like we're avoiding certain places, but we're also incorporating certain things like the international inflation bonds. Just understand that there's these changes that are happening and we have to keep up with it. I'll conclude with this. Viktor Frankl was an Austrian psychologist. He was also a Holocaust survivor. I think he was one of the few guys that survived Auschwitz. And he wrote a book called Man's Search for Meaning. And it was supposed to act as like a self-analysis of his experience in the concentration camp. There's a particular quote that stuck out to me recently. When we are no longer able to change a situation, when we are no longer able to change interest rates, if we are no longer able to change the economy, if we are no longer able to change, God forbid, the stock market, if we are no longer able to change war or geopolitics and all that stuff, we are then challenged to change ourselves. What are some things that you can change that really make your life better? What adds value to your life? Is it spending less time watching the news? Is it spending more time hanging out with your kids or grandkids or calling your sibling? Reconnecting with some old friends? We cannot and should not be afraid of change. Thank you.
All right, hi everyone. So I'm here to land this plane today. So I know Daniel shared a whole bunch of things, a lot of economic theories, things that we're looking at every single day, just trying to monitor what's going on in the economy, what's going on in the world. Wow, oh, I don't know. I don't know what happened there. But anyways, so those are just things that we're looking at. And Daniel wanted to share a little bit, just a little glimpse into, maybe 15 minutes of what we're looking at every day. So if your head's spinning, that's okay. That's why we're here. But we just wanted to share just a little bit of what we're looking at and a little bit of the why behind we make some of the decisions that we do when it comes to your portfolios, why we have a little bit more domestic than international, and things that we're looking at, when it comes to currencies. So for the future, 15 years down the road, what is our world going to use for currency? We're looking at that because that's relevant to how do we structure your portfolios. So anyway, I'm going to kind of get a little bit more into kind of practical, what's happening here in the local economy, where are we at right now, talking a little bit about what the federal government's doing, what's happening with yields, just a little bit about what's happening. So I'm not going to spend long on this. In February or January, I talked all about market emotions. This is a small snippet. So in February, we were somewhere up here, right? At the beginning of the year, markets had peaked, and we were starting to head down this road. We didn't know where we were at, but we're feeling that way. Fast forward quite a few months, we're somewhere down here. I don't know where. You can judge how are you feeling, but by a lot of the conversations I'm having, we're somewhere over here. And so note, point of maximum financial opportunity. So today what I'm talking about is what opportunities do we have, what are we taking advantage of for your portfolios, those sort of things. So before we get into that, I just want to do a little bit of a snippet. Where are we at this year? So here's where we're at. And just for perspective, I put it on a 22-year time horizon is what's showing here. So back over here at the beginning of the millennia, we had the dot-com burst, 9/11. It kind of went along here. Of course, the Great Recession, 08, when the mortgage crisis happened, and that was pretty rough right there. But then for the next 10, 12 years, things had kind of come back. Of course, we have lovely COVID, this really steep dive right here. We've made it through it, and here's where January 1 was. Now things have progressed downwards. We've had a lot of volatility up and down, but it's trending down right now. But I will say, note where we're at right now. We're still higher than we were even at COVID's peak. So it's just a little perspective. I know this down feels horrible. It feels horrible to look at stuff and see, oh gosh, there's losses, things are going down. I get it. I have my accounts too, and mine are super aggressive, so it's real bad. But, so I'm sorry, I went too far. So recession. So Jim said it, whether they want to say it or not, we are in a recession, and it's cyclical. Recessions happen, every so many years. So just wanted to say that's kind of where we're at. We don't know where the bottom is. We're looking at things like Daniel said, all sorts of theories, things like that to try to determine that. But another thing we're looking at is that we're kind of catching up on is unemployment starting to rise. And no, we're not laying off Charity and Jessica, but there is unemployment that's starting to rise. So we're looking at that domestically. What does that mean for the stock market? So this is just a little bit of perspective here. But with recession comes the question, should I buy gold, right? We're getting a lot of questions. Do I buy gold? Historically, gold has kind of been operated differently than the stock market, kind of inverse, as a hedge. Once again, I like perspective. So this chart right here is showing some perspective over the last, 100 years or so. The orange is gold, so nothing too much happening here, and the blue is the stock market. So as you can see, as time has gone, gold it's still kind of going up, but it's a whole lot slower than what's happening with the stock market in the blue. So with gold, we're not getting the crazy returns that you would if it were invested in the stock market. Even if you rode through all the different bumps here, you're still getting a whole lot higher return. The other thing, just to keep in perspective with this, is right here. I just threw a little chart of what has gold done this year. So it started off right here. As things started to get bad, it did start to go up. But as things have progressed, it's actually lost value too. So it's not the necessarily safe haven that everyone thinks it is. It's not bad to have a little bit in gold for diversification's sake. We actually, in some of the investments we use, there is gold embedded in it. So many of you do have a little bit of gold in your portfolio for diversification. Just putting a little bit in a lot of buckets. So most of you do have a little bit of gold, but perspective, it's not always what it's cracked up to be. Now, if you're looking at going to buy some physical gold, right, hearing what Daniel's saying, and digital currencies starts to freak you out, get it. If you're going to buy physical gold, there's a lot of considerations you want to make sure that you're looking at to make sure you don't get ripped off by who's buying it, who's selling it, where are you storing it, all sorts of things. So if you're thinking about that, come talk to us. But should you buy gold? Maybe a little bit's fine. You already have some of it in your portfolios. But don't cash out everything and put it in gold. So this is about the last area before I get into all the opportunities, but showing history of market downturns. That's where we're at right now, right? Since 2022, the market's been in a downturn. So this graph right here I thought was a really great visual representation. The blue right here at the top are bull markets, or when the markets are up, and the red is where the market's down. Over the last 70 plus years, the blue has risen a ton. We've had a lot of great returns on average. This is just average, not holistically, but average. The stock market's up almost 280%. Pretty awesome. and the average duration of it, the average time that it's up, is 72 months or 6 years-ish. Then we gotta, of course, compare, right? Things go up, things go down, up and down. The average bear market, sure it happens, you can see it happening periodically. It only typically, on average, lasts a year, or a little bit over a year. And it goes down on average 33%. Now that 33% feels really bad when it's happening. Right now, the stock market's down 23% right now, and it feels bad. But when you take this and compare, okay, here's where it's down, but when you compare it to this up 280-ish percent, you have some pretty nice returns when you average it out. So what I'm saying right here, usually the down times are shorter and they're less, you're losing less than what you're gaining in the blue times. Doesn't mean it feels any better to be in the down times, but if you can stick it out, this is well worth it. So the first opportunity is market rebound. So when things come back, they come back real quick. This is a chart of the last 100 years, and here's the red part with the losses for each of the different ones, and once again, doesn't feel good. But when you get through it, look at these returns. So for the most recent big one, COVID was not fun, but it was kind of artificial. So the last real one, this financial crisis, things were down 57%. Feels bad. But if you ride it through, and this is a pretty longer, it was a longer one that lasted, but things came up 326%. So, and those came back pretty quick. So there's some days that the market went up 5%. And if you missed that, well then shoot, you missed a 5% return here. So right here, what I'm talking about, when it comes back real quick, this is just a hypothetical. If you had put your money in and kept it in, said, okay, it's gonna be here, I'm gonna trust Eldorado, they got it, it's gonna be fine. And maybe you call and ask some questions, but you don't pull it out. If you ride it through the down times that are pretty bad and through the upswings that are phenomenal, you'd be at, it'd grow 172,000. But say, you think, okay, I know what I'm gonna do. I'm gonna get out while it's high, and I'm gonna buy in when it's low. Sounds great, right? Like we buy low so high, but when are those days is the hard thing. We all know what to do, but you don't know when exactly it's gonna happen. So, say you try to do that and you happen to just miss the 10 best days. Well, at that point, you're not at a loss necessarily, but you still didn't gain all this up here that you would have if you had kept it. And say you are out longer and longer, the longer you're at, you're actually looking at losses. So, with this, put it in, keep it in, and don't try to time the market. Gosh, if we could time the market, we sure would, but nobody can do that. So they might be right a few times, but they're never right all the time. And all it takes is one time to be wrong for you to lose all this. So the next opportunity area, Jim mentioned it a little bit, Daniel mentioned it internationally, is inflation. We've been talking about inflation. I feel like we talk about it every single seminar because it's a real thing, and it's one of the real dangers for our society. So cost of goods are going up. I know that. Every time I go to the grocery store, my bill's higher and higher and higher. So this kind of shows over the course of time what's happening with your dollar. It was up here, what the dollar's buying is getting less and less. No surprise, you all know you're living it. But what do we do with that knowledge? And more importantly, what I'd like to talk about, or like Milton Friedman to share, is why does inflation exist first?
Inflation is just like alcoholism. In both cases, when you start drinking or when you start printing too much money, the good effects come first. The bad effects only come later. That's why, in both cases, there's a strong temptation to overdo it, to drink too much and to print too much money. When it comes to the cure, it's the other way around. When you stop drinking or when you stop printing money, the bad effects come first, and the good effects only come later. That's why it's so hard to persist with the cure.
So wise man, an interesting kind of correlation, right? So let's talk about printing money. This is the Federal Reserve kind of spending versus revenue. So as you can see, here's the green. Here's what they're getting in via tax dollars and all sorts of other things. Here's what they're spending it on. So there's $2.7 trillion difference. So what do they do to make up that difference? They print money. And that's why we are in the world we're in today. We're printing a lot of money. So that's something we are going to need to see start to change if we're going to see inflation start to get under control. So the government did do something. They did an Inflation Reduction Act. Here's all the categories, but really, they cut down the deficit by $300 billion. So now our deficit is 2 trillion or something like crazy like that. That was quick math. So we basically did a little trim off the edge. Their hearts were in the right. They were trying to think of the right thing and didn't do much to really quench it. So I think we're going to still see inflation. There's nothing that's happening to necessarily pause inflation. Money's still being printed. The Federal Reserve's doing a little bit, and I'll talk about that here in a second. But like I said, right now we're going to still see some high inflation. So we've talked about this before. This is something that we've been aware of for the last year, 2 years, is inflation, and we've had a lot of everyone invested in Treasury inflation protected securities. So that's something we've had just to try to address this issue of inflation, trying to help get you some decent dividends returns to try to keep pace with inflation. Now, they might not be at where real inflation is, but it's sure a whole lot better than the bank where you get a few cents on what you have invested. So our goal is to kind of help you have some dividends to help keep pace with inflation. So we have a few different Treasury inflation protected securities tips that we've been using in your portfolios. Daniel mentioned we have some that are also international. So we're trying to hit on a few different areas. As I mentioned, the Federal Reserve is trying to do something about inflation. You probably have heard about it. Jim mentioned it. They've been raising interest rates. So here's a kind of cool graphic over the last few years, but you can see in the Great Recession, they really cut down interest rates. They started to climb. COVID happened. They dropped them down to 0 again. Everybody was getting mortgages on their house or refinancing for pretty low rates. But inflation has spiked. And so they're addressing it. They started small, and the rate increases keep getting higher and higher. The last 3 have been at 0.75%. So they're trying to increase these interest rates in order to help slow down inflation so that hopefully, we can kind of calm down the cost of goods getting ratcheted higher and higher. It's hitting the real estate market, that's for sure. Real estate has been really hot for the last 2-3 years with the low rates, and now we just saw that a 30-year mortgage was at 7.5%. Yeah, so we're going to start to see how home values kind of normalizing because they've been real high. People aren't going to be able to afford some of those payments. I mean, it's a pretty hefty monthly payment that you're looking at if you're at 0.75. So that's going to start to help a little bit with the economy. It'd help if the money would stop being printed, but at least this is kind of on track. Now, we'll keep an eye on what the Federal Reserve is doing because at some point they might lower rates to try to stop the recession. So we'll keep an eye on that, on what they're doing. But right now, with the interest rates and them raising it, there's some cool opportunities that we have. Jim started to mention it a little bit. So one of them being that we now have access to CDs. Not right for everyone, not right for every situation, but we have CDs at 4%, which not too shabby. I mean, not quite where inflation is, but not too bad when you're looking at the safety of the investment and the 4% return. We also have the money markets, as Jim mentioned. And the other one that we're looking down the road is more so the bonds. So just a little bit of perspective of what we did before and what we're looking at with bonds being with interest rates being at near 0. We've kept you in short-term bonds for a while because we knew at some point 0 is pretty much the bottom, pretty much, and it has almost nowhere to go but up. So when a bond, if they raise the interest rate or the yield, then your bond price is going to fall. So we've kept everybody in short-term bonds for the last few years, knowing that at some point they were going to raise rates. And it helped protect your assets from falling too much. But now, as they're raising rates, there's some interesting opportunities out there. So we've shifted out of those short-term bonds into money markets because they're paying better and they're really, really, they're pretty safe. Incredibly safe, actually. So we've shifted that. But now we're looking forward to the future. As they continue to raise interest rates, you're going to be able to get some bonds, which are more safe than a stock market, that are paying better yields. So this is where we're at. So we're looking at down the road, can we shift into some bonds that are going to get you better interest, better dividends, better income? The other opportunity that I have right here is after COVID, growth stocks right here, like you can see, Amazon, Google, Tesla, et cetera, they recovered really well after COVID. They shot right up, and some of these value stocks lagged behind, and that's okay. Things are cyclical. Certain things do better at certain times. So we reaped the benefits of this growth right here, but now where we're at, this year, growth has been hit hard. And so things we have been doing is shifting from these growth stocks into these value stocks, where these value stocks, they can grow themselves, but also they're paying dividends out, paying you interest out. So that's one thing we've been doing a lot, looking at that domestically, also internationally. So kind of the last topic I wanted to just hit on, I know everybody's thinking about it, what's going to happen with the midterm? Well, I am not a political analyst. I don't know what's going to happen, but I can tell you what we're looking at. So with the midterm coming up, leading up to the midterm, there's a lot of uncertainty, right? Who's going to win? What's going to happen? Which houses are going to be in power, et cetera, et cetera. And the stock market hates uncertainty. So it's going to be really volatile leading up. Once we have a decision, things will start to calm out because the stock market will know, okay, we at least know what to expect. So we're looking at that. Whichever side ends up winning, I think that the stock market really also likes gridlock. So it likes the checks and balances that our government has established. So it likes when things can't move really quick and they can't change the rules of the game really quick. It likes when it knows what's going to happen and keep on keeping on. So it'll be volatile leading up to that election. Once the election happens, then we'll start to see it kind of calm down, regardless of which way it goes. So what now? 3 things. 1, as Daniel said, control what you can control. So he mentioned a few things. You know, maybe when it comes to your money, maybe it means budgeting if you feel tight. Maybe it means thinking about what you should spend. If you have extra money, maybe it means spending it and getting to enjoy it because you earned it. Think about what you can control. Number 2, let us handle and do what we do best. So Daniel went into a little bit of the theories and all this crazy stuff that we look at all the time. There's a whole lot more in that, so let us do that. If you have questions or concerns or you're worried, it's okay, you can call us. But let us talk through it with you. Let us know what questions you have. But really, let us use our expertise to help get you there. And finally, as Daniel said, let go of what you can't. So there's certain things that you cannot control. With the midterm elections, you can control voting, but you can't control the outcome. So do those things, you know, let go of the rest, pray about it, meditate it, whatever works, but let go what you can't and keep the rest of these in mind. So with that being said, fill out your surveys if you can. If you have questions, either write them down and we'll call you, email you, text you, or find one of us after this and we'll help answer it. But any kind of feedback you have for us, we appreciate it. And thanks so much for coming, guys.